Gold just did something it has only done 3 times in 25 years. And the last 2 times it did this, what followed changed everything. Yesterday, gold touched $5,089, a new all-time high. Then, in the same session, it flushed back to $4,940, a $149 swing, intraday at an all-time high. That kind of move at that level means one of exactly 2 things. Either institutional money is arriving so fast that the pullback is nothing more than a loading dock pause before the next leg up, or someone with an enormous short position is defending a line they cannot afford to lose, and they are spending serious firepower to hold it. By the end of this video, you will know which one. You will know what gold just signaled, why 3 specific institutions are quietly terrified of what happens next, and the 4 scenarios that map out whether this breakout is the real thing, or whether a coordinated takedown is already being engineered. Welcome to the hidden economy. If you are new here, I expose what is really happening in markets while everyone else is distracted by the headlines. Subscribe right now, because this is the kind of analysis you will not find anywhere else. And if you find value in this video, smash that like button. It helps the algorithm put this in front of people who need to see it before the window closes. Now, let me show you the signal, because this is not a normal technical event. Gold just closed above its 12-month moving average, while simultaneously setting a new all-time high, while the dollar was strengthening, not weakening, strengthening. Gold and the dollar are supposed to move in opposite directions. That inverse relationship is one of the most reliable in all of macrofinance. When the dollar rises, gold falls. When gold rises, the dollar falls. That is the rule. Gold just broke the rule, and when gold breaks the rule, it means the safe haven bid is so powerful, so urgent, so driven by something deeper than currency fluctuation, that it is overriding the most fundamental relationship in the market. The last time this pattern appeared was October 2007, 3 months before the global financial crisis began. Before that, August 2002, the launch of the greatest gold bull market in modern history. This is not a random candle on a chart. Every single time this pattern has appeared, something structural was already breaking underneath the surface. The market just hadn't been told yet, and right now, 2 things are happening simultaneously that cannot both be true in a healthy system. The first, central banks are buying gold at a pace that has not been recorded since the Bretton Woods collapse in 1971. The World Gold Council confirmed that central banks purchased 1,136 tons of gold in 2024, the 3rd consecutive year above 1,000 tons. Poland, India, China, Turkey, Czech Republic, over 40 sovereign nations moving in the same direction at the same time. This is not diversification. This is evacuation. When 40 central banks simultaneously sell U.S. treasuries and buy gold, they are not making a portfolio decision. They are making a verdict on the dollar, using the oldest store of value in human history as their exit vehicle. And they have access to information about the dollar, about U.S. debt, about the global reserve system, that the retail market will not see for another 6 months, maybe longer. The second thing, the London Bullion Market Association, the largest physical gold trading hub in the world, is bleeding. Withdrawal requests from LBMA vaults in London have spiked 340% since November. Gold is being physically pulled, loaded onto planes, and shipped to New York, specifically to COMEX, to meet delivery demand. And here's the number that should stop you cold. The premium for a gold bar with a COMEX stamp over gold bar with an LBMA stamp has hit $40 per ounce. Let me explain why that is insane. Same metal, same purity, same weight. One bar is worth $40 more because of which vault it is sitting in. That premium should be 0. It is $40 because physical gold in the right vault with the right stamp is worth more than the same ounce in the wrong place. When location creates a $40 premium on identical metal, the system is not functioning normally. The system is under stress. Think of LBMA London as the wholesale warehouse and COMEX New York as the retail shelf. When the retail shelf runs low, you pull from the warehouse. That is normal. But when the warehouse starts running low, too, that is when the store manager starts making phone calls he hoped he would never have to make. The last time LBMA to COMEX gold shipments spiked this aggressively was March 2020, when COVID froze air freight and the gold market briefly broke. Back then, the premium hit $70 before emergency transfers restored order. Today's $40 premium is building in a fully functioning supply chain. No pandemic, no freight freeze, no force majeure, just demand outrunning supply. Now here is who is on the other side of this, And this is where it gets uncomfortable. 3 institutions hold the largest concentrated gold short positions on COMEX: Citibank, HSBC, Bank of Nova Scotia. Combined short exposure estimated at over 800 tons, more than the entire annual output of every gold mine in the United States, combined. Every dollar gold rises above 5,000 costs these institutions hundreds of millions. The $149 intraday flush from the all-time high was not random profit-taking. Someone needed gold below 5,000 badly. And they had the firepower to make it happen, at least temporarily. I'm not alleging crimes. Short selling is legal. Defending a position is legal. But the entities with the most to lose from gold above 5,000 are the same entities with the most influence over exchange mechanisms. Draw your own conclusions. Now, here's the smoking gun. The signal that tells you this is not a normal market, and the paper price is not telling you the truth. The gold futures curve is in backwardation. In every normal functioning market, futures contracts trade at a premium to spot price. That is because of carrying costs: storage, insurance, financing. You pay more for gold delivered in 3 months than gold delivered today, because holding it costs money. When that flips, when gold for immediate delivery costs more than gold for future delivery, the market is sending one message: we need metal. Now, not in 3 months. Now. Gold has been in backwardation for 11 consecutive trading days. 11 days. The last time gold remained in backwardation for this long was September 2008, 2 weeks before Lehman Brothers collapsed. I'm not saying a Lehman event is coming. I'm saying the signal that appeared before Lehman is appearing again. And the last time that signal appeared, the people who ignored it did not get a second chance to act on it. And simultaneously, while the futures curve is flashing this warning, gold ETFs just recorded their largest single-week inflow since March 2022, $4.3 billion in 1 week, flowing into GLD and IAU, retail and institutional money, moving in the same direction at all-time highs at the same time. This is not the behavior of a bubble topping out. Bubbles top when the last buyer has bought and there is nobody left. This is the behavior of a market where institutional capital is still arriving and the physical supply available to meet it is shrinking every single day. Now, here's the part that kept me awake last night, because this one almost nobody's talking about. There's a $600 billion problem sitting in the U.S. Treasury's calendar right now, $600 billion in U.S. government bonds maturing in the next 90 days, bonds that need to be rolled over, refinanced, sold to new buyers at today's interest rates, rates that are dramatically higher than when those bonds were originally issued. The Treasury needs buyers. The traditional buyers, foreign central banks, are net sellers of U.S. Treasuries for the 5th consecutive quarter. They are not buying the new bonds. They are selling the old ones. And with the money they receive, they are buying gold. Read that sequence again. The largest holders of U.S. government debt are selling that debt and converting the proceeds into gold. When your largest creditors stop buying your bonds and start buying gold instead, gold is not a trade anymore. Gold is a verdict on the dollar, being delivered in real time by the people who know the most about what the dollar is actually worth. And this is not just happening at the institutional level. In Turkey, where the lira has lost 80% of its value in 4 years, the government just restricted gold imports because citizens are converting savings to gold faster than the central bank can manage the capital flow. In Egypt, physical gold premiums have hit 25% above spot as the population abandons the pound. In Argentina, gold dealers are reporting 6-month waiting lists for physical delivery. These are not investors making portfolio decisions. These are people with families, with savings, with everything they have built over a lifetime, watching their currency dissolve and reaching for the one thing that has survived every currency collapse in 5,000 years of recorded history. What they are doing individually, central banks are doing at the sovereign scale simultaneously. Now let me give you the 4 scenarios, because the next move from here is not a coin flip. The probabilities are not equal, and your position either survives what is coming or it does not. Scenario 1, the breakout is real, and it extends. LBMA vault withdrawals accelerate. The COMEX premium widens past $60. Backwardation deepens beyond 15 consecutive days, which would be unprecedented in modern gold market history. ETF inflows continue. Gold breaks 5,200, and the institutional shorts begin unwinding because the cost of maintaining the position becomes existential. Central bank buying pace is maintained through the second quarter. The Treasury rollover stress becomes a public narrative, not just a technical footnote. The dollar confidence story cracks visibly. In this scenario, gold does not pause at 5,500. The silver to gold ratio currently sitting at 65 to 1, historically elevated, begins compressing at the historical average of 40 to 1, with gold at 5,500. Silver implies $137. Probability, 40%. This is the most likely single outcome. Scenario 2. Controlled consolidation. Gold holds the floor while physical tightens further. The institutional shorts successfully defend 5,000 temporarily. Paper sells keep the headline number below the psychological level, but they cannot force gold below 4,800 because every manufactured dip gets absorbed by physical demand. Central banks, industrial buyers, sovereign funds. They treat every pullback as a discount. Gold grinds. It does not explode, but the direction is clear, and the floor gets higher with every week that passes. The LBMA COMEX premium stays elevated. Backwardation persists. Chinese buyers, who return to the market on February 24th, provide a consistent physical bid underneath every paper sell. Probability, 35%. Scenario 3. Coordinated takedown attempt, a replay of the January silver attack applied to gold. CME raises gold margin requirements. Coordinated, potentially with LBMA, using the same playbook that crashed silver 46% on January 30th. Paper gold flushes to 4,400, maybe 4,200. ETF outflows spike, retail panic sells. Financial media declares the gold rally over, and institutions, the same central banks that bought at 3,000, buy more aggressively at 4,400. The takedown works, short term. It fails, structurally, because the vault drain continues. The Treasury rollover problem does not disappear. The 40 sovereign nations selling dollars and buying gold do not reverse course because of a margin hike on COMEX. If this scenario activates, the signal is a CME margin announcement, combined with a sudden coordinated media narrative that gold is overvalued. Watch for both together. That combination is not coincidence. Probability, 20%. Scenario 4. Macro reversal. The Fed pivots back to hikes and the dollar surges. Inflation reaccelerates beyond what the market has priced. The Fed signals rate hikes, not cuts. The dollar index spikes above 110. Gold corrects to 4,200. The structural bull case does not end. Central bank buying continues regardless of Fed policy, because their decision to buy gold is not about the interest rate differential. It is about the dollar's role as the global reserve currency. That story does not change with one Fed meeting, but in the short term, this scenario is painful for gold holders who bought at 5,000. Probability, 5%. This is the least likely outcome. And even here, it is a pause, not a reversal. Now, 5 things to watch in the coming days, not price levels. Price levels are noise right now. These are the signals. The LBMA to COMEX shipment data, is the vault transfer accelerating or has it plateaued? If it accelerates, scenario 1 is moving forward. The gold futures backwardation streak, if it crosses 15 consecutive days, that is territory that has never been charted in modern gold markets. The COMEX registered gold inventory. Watch for the same drain dynamic that appeared in silver inventory 6 months before the January crash. The World Gold Council monthly central bank purchase update. Is the buying pace being maintained, or are sovereigns pausing? And the U.S. Treasury 90-day auction results, specifically the foreign participation rate. If foreign buyers continue stepping back from Treasury auctions, the dollar story accelerates, and gold goes with it. These are not just numbers. They are the instruments on a dashboard of a system that is already showing warning young lights. If you are holding physical gold right now, every central bank that sold treasuries and bought gold this quarter validated exactly what you are holding. You are on the same side of this trade as Poland, India, China, and 40 other sovereign wealth managers, who collectively have access to information the retail market will not see for another 6 months. The $149 intraday flush is not a reason to reconsider your position. It is the cost of holding the asset that 40 governments are fighting to acquire. If you are thinking about buying gold at 4,940, after touching 5,089, is not a failed breakout. It is a retest. The question is not whether 5,000 holds today. The question is whether you are positioned before the Treasury rollover crisis that becomes a headline. And if you hold paper gold, ETFs, and futures, understand what the $40 LBMA COMEX premium is telling you. Paper gold tracks the price. Physical gold, in the right vault, commands a premium that is growing, not shrinking, as the drain continues. That gap does not close by physical coming down to meet paper. It closes when paper has to come up to meet physical. 40 central banks are selling the dollar and buying gold simultaneously at the fastest pace since Bretton Woods collapsed. You can ignore that signal. Or you can ask yourself, what do they know that hasn't made the news? Yet, this is my opinion, not financial advice. Your money, your decisions. Drop your number in the comments. And where does gold close by end of Q2? Above 5,500. Controlled consolidation at 4,800. Coordinated takedown to 4,400. Or macro reversal below 4,200. I want to see your call. Share this with one person who thinks gold is just a hedge and doesn't understand yet that 40 sovereign governments are making it their primary reserve asset. If you haven't subscribed yet, do it now. I am covering the LBMA drain, the backwardation streak, the Treasury auction data, and the COMEX premium every single day in real time until this resolves. This is the hidden economy. Stay sharp, stay stacking, and I'll see you tomorrow.